Chapter 15, Using Management and Accounting Information. Although this chapter, like a few of the others, really focuses on two very large topics, I'm going to narrow it a bit and just focus on the accounting portion. As a colleague of mine likes to say, accounting is the language of business. And I'm going to include a very interesting clip on accounting basics that makes exactly that same point, although in kind of a cuter fashion. So why is accounting important? Well, let's look at that. But first I want to define a couple terms. An audit is an examination of a company's financial statements and their accounting practices. And this makes sense because companies do have an incentive to make themselves look as good as possible, especially to their investors. So an audit ensures or attempts to ensure that things are as they say they are and that the company has followed what's called GAAP, or generally accepted accounting principles. Speaking of following GAAP or not following GAAP, I'd like to show you a clip that's kind of a teaser for a really interesting movie called Enron, the Smartest Guys in the Room.
At Enron was pride, arrogance, intolerance.
Money you guys stole from those poor grandmothers?
We can add $1 gazillion to the bottom line.
Now, if you'd like to see the movie in its entirety, it is available on Netflix. Of course, it's also available on YouTube, but you'd have to pay for it. It's really fascinating. At the time of the Enron fraud, there were a couple of other large-scale corporations like WorldCom and Parmalat that were also doing what's called cooking the books or committing accounting fraud. And so as a result of those misdeeds, that really ushered in Sarbanes-Oxley, which was a huge change in the law that affects all publicly traded companies. But I want to disagree with one part of the slide here. Definitely the accounting fraud did hurt the employees and the investors and the lenders and the suppliers, and in fact the economy as a whole suffered for these misdeeds. But I want to disagree slightly with the high-paid corporate executives not paying for it. A number of them did get away with it, I'm sorry to say. But those that did get caught, notably like Jeffrey Skilling, did go to jail for quite a number of years. In his case, it'll be decades. So they are getting a little bit more serious on this type of white-collar crime. But as I said, the misdeeds of WorldCom and Enron executives and others ushered in Sarbanes-Oxley, which was really a pretty strenuous, a strenuous attempt to mitigate accounting fraud. And so one of the things they did is they tried to toughen up the SEC. The SEC, as you probably know, is the Securities and Exchange Commission, the government body that's supposed to oversee publicly traded companies. And if you look at the fraud that was committed and, things like the Ponzi scheme that we talked about previously with Bernard Madoff, it looks like the SEC folks to date, at least, haven't done a great job with policing the accounting industry. Some other changes with Sarbanes-Oxley, these are among the top 3, but I'm going to include a link to Wikipedia, interestingly enough, that lists in a very straightforward fashion some of the major changes with Sarbanes-Oxley. But number 2 is on this slide is another one of the big ones that says top executives must certify periodic financial reports. I hope you do get a chance to see the Smartest Guys in the Room, because it is just fascinating and shocking when Ken Lay, who was the then CEO, says, it wasn't my fault. I didn't see what Andy Fastow, the then CFO or Certified Financial Officer, I didn't see what he was doing. And so the Sarbanes-Oxley says, you know what? If you're in charge, you're going to look everything over and sign it off. You can't pretend that you didn't know what was going on. And then last, accounting firms cannot provide many types of non-audit and consulting services to the company they audit. This was another just fascinating facet of the Enron debacle, in that their accounting firm was also doing consulting work for them to the tune of $1 million a week. So their auditors had a pretty stiff incentive to kind of look the other way and let them get away with things. So Sarbanes-Oxley says, no, we're going to eliminate that particular conflict of interest. A couple of other points on Sarbanes-Oxley. Auditors must maintain financial documents and audit work papers for longer than in the past. And it goes on about how they can't destroy documents. The reason why this was put in was because when the accounting firm that was supposedly auditing Enron, when the SEC started looking at them, they sent out a memo saying, clean up your offices, which meant that the auditor started shredding documents, and they shredded truckloads of documents. Because that accounting firm was so in bed with their client, that's why we have the stipulation that a public corporation must change its lead auditing firm every 5 years. And then last, the provision about protection for whistleblowers. When Sherry Watkins, one of the vice presidents, came out and said, you know what, this is wrong, Ken Lay's first reaction was to ask the lawyers if they could fire her. And they said, well, that'd be a really bad idea, because then she would sue and everything would come out in trial. So, hence the protection for whistleblowers, because there usually is some form of retaliation. But I want to reiterate that this protection only applies to publicly traded companies. Okay, what are the different types of accounting? As you'll see in the clip that I included earlier, there's managerial accounting, which is for internal decision-making, financial accounting for external decision-making. And then they add the third one, which is tax accounting, and that's, of course, what the government is interested in. I'll also include a clip on the AI, or a link on the AI CPA, which provides really useful information on becoming an accountant. It's interesting that they talk about, being a CPA, but they don't talk about an EA. An EA, or enrolled accountant, is also an option here. But the AI CPA is a really useful organization if that might be a career path that you're interested in. So let's drill down a little bit further. One of the key things that you have to be familiar with is the accounting equations. And that is that assets equals liabilities plus owner's equity. And if you look at the balance sheet, it's really kind of an elegant illustration of the accounting equation. Assets are resources that a business owns, liabilities are debts, and then an owner's equity, of course, is the difference between the two. And I'm also going to include a clip that kind of expands on the accounting equation as a technical explanation. So double entry bookkeeping means anything you do on one side, you have to do on the other side of the equation, so that you're always in balance. So I mentioned the balance sheet a minute ago. I really like the way that your authors explain this by personalizing it first and giving you an example, looking at your own life. What are your assets? Well, you probably have hopefully a little bit of cash in your wallet. You might have an automobile, you might have a stereo system, a nice phone. What do you own? And then on the opposite side of that, what are your liabilities? Do you have credit card loans? Do you have student loans? And then if that's a positive, then that's your net worth. And it could be a negative. As a student, that's certainly quite conceivable that you may be in the red. That's fine as long as it doesn't persist forever. And then this is a good example of a business balance sheet, and showing you the assets and liabilities, and then left over being the stockholders' equity or owner's equity. So let's talk a little bit more closely about assets. And they're listed, if I go back back to this balance sheet, you'll notice that they're listed in order of liquidity. Well, what does that mean? Well, it means that we're going to list the one that's closest to cash first, meaning that what can we convert quickly into cash? And obviously, the quickest thing we can convert to cash is cash itself. And then it goes down the list to things that are take longer to convert to cash. Okay. So you've got current assets, which, as I said, can be quickly converted to cash. Fixed assets, those will be held for a year or longer. And then you'll notice down here we have intangible assets. So intangible assets would be things like, the secret formula for Coke. Wow, that's got a tremendous amount of value, but it's not so tangible. Or what about a patent or a copyright? Those could have tremendous value, but we don't touch them the way that we touch a table. Nevertheless, they're very, very important, and so we want to account for those on the balance sheet. So liabilities is listed in the same way, but you'll notice the shorter term ones, the ones that have to be paid off sooner, are listed first, and then we've got longer term liabilities. So the second major financial statement is the income statement, which is a summary of a firm's revenues and expenses during a specific period of time. And once again, I like the way that they do this because they give you an example of a personal income statement. You think about what you take home in your paycheck versus your rent, your food, your utilities, take that out, and hopefully you've got something left over. If you do, it's a profit. If not, it's a loss. And then they compare that to a business income statement. So a couple of terms also to be familiar with, of course, are revenues, gross sales, and net sales. And this is where Uber has gotten into a bit of trouble recently because it turns out that they, let me see if I can flip to that. Uber was taking their fees out based on gross sales, and they should have been doing it on net sales since 2014. So they're having to reimburse a number of their drivers. Yet another embarrassing element for Uber, who's had a tough time recently. So it makes the point that good accounting is very, very important. A bit on cost of goods sold, and one of the common methods for determining cost of goods sold. And a couple of other terms to be familiar with: operating expenses, net income, and net loss. Very, very important ones. So I'm going to put this exercise in the discussion forum. And then the last financial statement that I want to touch on is the statement of cash flows. And you can be profitable, you can have revenues exceeding expenses, but if you don't have cash on hand, you may still have trouble paying your bills. So the cash flow statement is very, very important because of that. And you might say, well, this is very, very interesting. How would I get access to a company's financial information? And so I'm going to include a couple of good links for you to some annual reports on companies I think you'll find of interest. And then last, I'm going to finish up with 2 ratios. We're not going to drill down into this too far. If this is of interest to you, I'd encourage you to read the next chapter on financial management. But 2 ratios at least to be aware of. One of the biggies is the current ratio, which evaluates a firm's ability to pay its debts. And that's current assets, the ratio of current assets to current liabilities. And then the last ratio is inventory turnover, which is cost of goods sold to the average in the industry. So these are useful as kind of benchmarks to see where your firm is at in terms of financial matters.